Let me begin by setting a clear frame for this conversation, because framing matters more than most people realize when we talk about money, systems, and long-term outcomes. This is not a discussion about fast profits, sudden moves, or emotional reactions to price charts. This is a conversation about structure, positioning, and the way real financial systems change over time. If your interest is in understanding how wealth systems evolve quietly before they become obvious, then you are in the right place. Something meaningful is formed around XRP, not loudly, not dramatically, and not in a way that rewards short-term attention. It did not show up as a sudden spike on a chart, which is why most people missed it. The majority of market participants spend their time watching candles move up and down, reacting to headlines, and chasing narratives after they are already visible. What they tend to miss is that the most important shifts in finance usually happen beneath the surface, long before price reflects them. This discussion is about that deeper layer. It is about understanding what has changed structurally, not emotionally. And I want to be very clear from the beginning, this is not an attempt to convince, persuade, or promote. What I'm sharing reflects my own analysis and educational perspective only. There are no predictions here, no guarantees, and no instructions. The goal is clarity, not excitement. If you stay with this calmly and patiently, you will notice something interesting. Your focus may shift away from short-term noise and toward long-term understanding. That alone is valuable, regardless of what any single asset does. When people look at financial markets, they are naturally drawn to price. Price moves, charts change, and numbers create emotional reactions. This is understandable, but it is not how real financial systems are built or evaluated. In serious finance, infrastructure always comes before price. Price is the outcome, not the starting point. Infrastructure refers to the underlying systems that allow value to move, settle, and be trusted. This includes technology, legal frameworks, operational reliability, and integration with existing institutions. None of these elements are exciting to watch in real time, but they are essential. Without them, price movement is temporary and fragile. With them, systems can endure long after attention shifts elsewhere. In traditional finance, infrastructure development is slow and deliberate. Payment networks, clearing systems, and settlement layers are tested under stress, refined through regulation, and integrated carefully over many years. Institutions do not adopt systems because they are popular or volatile. They adopt systems because they are predictable, compliant, and efficient. This mindset often feels disconnected from the fast-moving culture of modern markets, but it is the mindset that governs real capital. XRP is often discussed in terms of market behavior, but its deeper relevance lies in its infrastructure role. It was designed to function within regulated environments and to reduce friction in the movement of value across systems. Whether or not the market is paying attention at any given moment does not change the purpose it was built to serve. That purpose exists independently of daily price action. Investor psychology tends to invert this logic. Many people look for price confirmation before they look for structural progress. When price is quiet, they assume nothing is happening. In reality, the most important work is often taking place during these quiet periods. Legal clarity improves, institutional familiarity grows, and technical systems mature. These developments rarely create excitement, but they create stability. Understanding this difference can change how people relate to markets. Instead of reacting emotionally to short-term fluctuations, they begin to observe longer-term patterns. They learn to separate noise from signal. They recognize that systems which last are not built quickly or loudly, but carefully and consistently. Infrastructure-first thinking also encourages patience. It reminds us that value is not created by attention alone. It is created by usefulness, trust, and integration. When those elements are in place, price becomes a reflection of reality rather than a source of confusion. In the end, whether we are discussing XRP or any other financial system, the principle remains the same. Strong infrastructure forms quietly, long before outcomes are visible. By focusing on structure instead of emotion, and process instead of prediction, we gain clarity. And with clarity comes patience, perspective, and a more grounded understanding of long-term positioning. In financial markets, progress is often mistaken for movement, and silence is often mistaken for stagnation. This misunderstanding shapes how many people interpret what is happening around assets like XRP. In reality, quiet progress is often the most meaningful form of progress, especially when systems are being built for long-term use rather than short-term attention. Serious financial infrastructure does not develop in public view. It evolves through careful testing, legal refinement, operational learning, and gradual integration. These processes rarely create headlines because they are designed to reduce risk, not to generate excitement. Institutions value stability, predictability, and clarity. When those qualities are being strengthened, the absence of noise is usually a positive sign. XRP has frequently been judged through the lens of market activity rather than structural development. When price remains calm or attention shifts elsewhere, many assume nothing is happening. This assumption reflects investor psychology more than reality. Humans are wired to respond to visible change. We struggle to recognize progress that does not announce itself. Yet the systems that endure are almost always the ones that matured quietly before becoming widely recognized. Quiet progress often includes improvements in regulatory understanding, clearer legal positioning, stronger institutional familiarity, and more refined operational use. These developments do not move charts in the short term, but they change how systems are perceived and trusted over time. Trust, once established, becomes a foundation that cannot be rushed or manufactured. From a long-term perspective, silence can indicate alignment. It can mean that fewer speculative forces are dominating the narrative, allowing practical development to continue without distraction. This phase is uncomfortable for those who seek constant validation, but it is necessary for systems intended to operate at scale within real financial environments. Investor behavior tends to amplify this discomfort. Many participants equate activity with opportunity and stillness with failure. This creates cycles of emotional engagement that often distract from deeper understanding. By contrast, patient observers learn to ask different questions. They look for signs of integration rather than excitement. They pay attention to consistency rather than volatility. Understanding quiet progress also requires a shift in expectations. Not all value is immediate, and not all progress is visible. Some Chang ES only reveal their importance in hindsight, when the foundation they created becomes obvious. At that point, the earlier silence is reinterpreted as preparation rather than absence. When applied to XRP, this perspective encourages a calmer, more informed view. It allows observers to step back from daily fluctuations and consider whether the underlying system is becoming more reliable, more understood, and more aligned with long-term use. These are not questions that can be answered by charts alone. In the end, quiet progress asks for patience and discipline. It rewards those who can remain steady when others lose interest. By focusing on structure, clarity, and long-term positioning rather than noise, we develop a more grounded understanding of how meaningful financial systems evolve. That understanding brings calm, reinforces perspective, and supports clear, long-term thinking. When people observe financial markets, they often focus on charts. Charts feel concrete. They move, they react, and they offer immediate feedback. But institutions do not think this way. Large financial organizations, banks, and payment networks think in systems, not charts. Their decisions are guided by structure, process, and long-term reliability, rather than short-term market behavior. A system is more than a price line on a screen. It includes technology, legal alignment, operational workflows, risk management, and integration with existing infrastructure. Institutions evaluate whether a system can function consistently under different conditions, whether it complies with regulations, and whether it can scale without introducing instability. These considerations take time, and they rarely produce visible signals for public markets in the short term. This difference in perspective explains why institutional activity often appears slow or invisible to retail observers. While ALS may react to daily movements, institutions are studying whether a system fits into their broader architecture. They ask whether it reduces friction, lowers costs, improves settlement efficiency, and aligns with long-term strategic goals. Price volatility is not a primary input in these discussions. In many cases, it is a risk factor. XRP is often discussed through chart-based narratives, but its relevance to institutions is rooted in system-level functionality. It was designed to operate within existing financial environments and to support efficient value transfer between different networks. From an institutional viewpoint, the question is not how the market feels today, but whether the system performs its intended role reliably over time. Investor psychology tends to misinterpret this process. When there is no visible price response, many assume there is no progress. This reflects a short-term mindset shaped by constant exposure to market data. In contrast, institutions are comfortable with long evaluation periods. They expect careful testing, gradual adoption, and iterative improvement. Silence for them is often part of due diligence. Understanding this distinction can bring clarity. It helps explain why structural developments do not always align with market sentiment. It also highlights why patience is essential when observing infrastructure-focused assets. Systems that aim to support real financial activity must earn trust before they earn attention. Thinking in systems also reduces emotional decision-making. It shifts focus away from prediction and toward observation. Instead of asking what the market might do next, the more useful question becomes whether the underlying structure is becoming more robust, more compliant, and more integrated. When we step back and view XRP through this lens, we begin to see a different picture. We see a system evolving within the constraints and expectations of institutional finance. This evolution is deliberate and often quiet, but it is aligned with how long-term financial infrastructure is built. In the end, recognizing that institutions think in systems, not charts, allows for a calmer and more grounded perspective. It encourages patience over reaction, understanding over speculation, and clarity over noise. These qualities support long-term thinking and help maintain perspective as financial systems continue to develop over time. In any serious financial system, risk is not managed through optimism or speed, but through clarity. This is why regulatory clarity plays such an important role in long-term financial infrastructure. Regulation is often misunderstood as an obstacle, especially by those focused on short-term market behavior. In reality, for institutions and system builders, regulatory clarity reduces risk and enables participation at scale. Financial institutions operate within defined legal boundaries. Their responsibility is not only to generate returns, but to protect clients, maintain stability, and comply with national and international rules. When regulations are unclear, even promising technologies become difficult to use. Uncertainty introduces risk, and risk discourages adoption. Clear rules, even if strict, provide a framework within which systems can function predictably. XRP exists within this environment. Its development has required engagement with legal and regulatory processes that are often slow and complex. From a market perspective, this process can appear frustrating or unproductive. From an institutional perspective, it is necessary. Each step toward clarity reduces uncertainty and increases confidence that the system can be used responsibly over the long term. Investor psychology tends to react negatively to regulatory discussions because they rarely produce immediate positive feedback. Legal processes do not move quickly and they do not generate excitement. However, they serve an important purpose. They define what is permitted, what is restricted, and how responsibility is assigned. Over time, this clarity becomes part of the foundation that supports durable systems. When regulatory understanding improves, risk models become more accurate. Institutions can assess exposure more realistically. Compliance teams can design procedures with confidence. Operational decisions become easier to justify. None of this changes daily market behavior, but all of it influences whether a system is considered viable at scale. A common mistake is to view regulation as separate from innovation. In reality, sustainable innovation requires alignment with legal frameworks. Systems that ignore regulation may move quickly at first, but they often struggle to integrate into real financial environments. Systems that engage with regulation move more slowly, but they build trust. This distinction matters when evaluating long-term positioning. XRP's ongoing interaction with regulatory structures signals an effort to fit within the global financial system rather than operate outside it. This approach does not appeal to those seeking rapid change, but it aligns with how major financial infrastructure has always evolved. For individual observers, understanding this dynamic can bring emotional balance. It reduces the tendency to react to headlines and speculation. It encourages a focus on structural progress rather than immediate outcomes. Regulatory clarity is not a catalyst for excitement, it is a stabilizer. As clarity increases, uncertainty decreases. As uncertainty decreases, systems become easier to integrate, govern, and maintain. This is the quiet work that supports long-term relevance. In the end, recognizing that our regulatory clarity reduces risk allows for a more grounded perspective. It reminds us that meaningful financial systems are built through discipline, patience, and alignment, not urgency. By valuing clarity over speed and structure over reaction, we reinforce a long-term view rooted in understanding rather than emotion.